What's up, everyone? It's Karthik with MoneyVest. So bank stocks absolutely getting crushed on the day with Ally Financial down almost 20% on the day with JP Morgan, one of the largest banks in the United States and in the world, down almost 7% on the day with Goldman Sachs, Bank of America, Deutsche Bank, Wells Fargo. Everything across the board is down very, very aggressively. We're seeing a pretty significant sell-off in the entire financial sector. So this right here is our watch list. We got Ally down over 19%, JP Morgan almost 7%, Deutsche Bank, Goldman Sachs down over 5% each, Citigroup down over 4.6%, SoFi is down over 4%, Barclays down over 3.7%, PNC is down over 3.5%. So across the board, we're seeing a liquidation of $67 billion between the top 5 banks. That is JP Morgan, Citigroup, Wells Fargo, Bank of America, and Goldman Sachs. Now, there was a conference from Barclays conference where there were comments from both the JP Morgan and Goldman Sachs CEOs. And the unfortunate thing is that the net interest income for these banks are currently estimated to be really high. In other words, there is an overestimation to how much that drop is going to be when it comes to that net interest income. And JP Morgan CEO Jamie Dimon also sounding the alarm on stagflation in the economy. And these banks, the data that these banks present is really, really important to figure out the health of the overall economy and how well the consumer is doing. So JP Morgan slumps 5% on guidance cut and falling federal interest rate fears. So shares falling almost 5% amid bank's president Daniel Pinto remarks, and also Jamie Dimon referring to these stagflation fears as well. And he told analysts that the bank was too optimistic in projecting next year's expenses and net interest income. The current net interest income estimates of almost $90 billion, according to Pinto, is not very reasonable given interest rate changes expectations. Now, investors know that this figure will be This figure will be lower for sure, and third quarter investment banking fees could rise 15%, while the market's revenue could rise 2%. Both measures came in below market's expectations. Also, Goldman Sachs expects third quarter trading revenues to fall as much as 10% year over year. So this right here was Goldman Sachs CEO saying the bond and currency trading is down 10% in the current quarter from a year ago, and JP Morgan also falling 7% following conference. Barclays reviews comments 17%. Return on tangible common equity may be more challenging in 2025. So those are some of the things that they mentioned. And look, the way the banks actually make money is they make money on what's called a net interest margin, right? So the interest that they pay on deposits versus the interest that they earn on assets like car loans, credit cards, mortgages, things like that, right? So for them, for banks, money is the real product. They're not making any product like Apple is making iPhones. Banks are creating money by selling the product, which is money itself. So money is the product that they're selling to people, and they're doing that by generating a cost, right? Generating a interest on that product. So whatever they pay to depositors on the accounts that they have versus what they earn on the assets like loans, student loans, mortgages, auto loans, things like that, that difference is the net interest margin, and that is also the net interest income for the bank. Now, when interest rates are on the way up, generally what happens is the interest that banks charge on these loans, right? So in other words, for the bank, it's an asset. So if you take out a loan, the interest that you're going to pay on that loan is going to be greater as interest rates continue to go up. So as we know, the mortgage rates, auto loans, credit card rates, everything's been pushing higher. Why? Because interest rates have been going up by the Federal Reserve. Now, that interest increase on assets for the bank far outpaces the interest rate increase that the banks pay on deposits. So in other words, when you deposit your money into a Bank of America account, you're not going to earn a high yield, right? You're not going to earn a high interest rate on your savings, on your checkings, even though the Federal Reserve has raised interest rates, right? So those are the earnings or the income that the bank does not pass on to the consumer, to the depositor. Some of the other banks started doing that, SoFi, Ally Financial. So those are the high yielding savings accounts that started to pass on some of those fees or some of those interest over to the consumer. But most traditional banks have not done that. So as JP Morgan, Bank of America, what they do is as interest rates go up, they try to maximize that net interest income or net interest margin. And now the opposite is also true. When interest rates start to come down, now the interest that they can charge on these loan products on the way down far outpaces the interest that they are going to be giving out to depositors on their accounts. And so that net interest income or that net interest margin starts to diminish for these banks, which is why we're seeing such a mass selling pressure. I mean, JP Morgan is having its worst day since 2022. Just take a look at that sell-off here, down almost 7%. Josh Brown was on CNBC earlier talking about how this is a gift for investors. If you don't own JP Morgan in your forever portfolio, this is a bit of a gift from the market. And Goldman Sachs here again down over 5%, with Citigroup down a little bit over 4.6%, and SoFi also aggressively selling off after hitting that resistance at $8, which we talked about in our previous videos, coming off of those highs as well, back down to 650s. Now, there's also some other really important things to look at. So Diamond warns on stagflation risk as well. Now, apart from the banking sort of problems with the net interest income and the net interest margin starting to diminish or really coming down to narrower levels, I think it's really important for us to also understand that banks are an important sector of the overall economy, and the consumers who obviously are going to have a much better understanding. In other words, the health of the consumer is what the banks really track, right? That's what they track. And they can give us a lot more insight into how the consumer is doing. And JP Morgan says that the US is still facing inflationary forces and cautioned investors to not to discount the risk of stagflation for the world's largest economy. And he says, and I quote, "I always say the worst outcome is stagflation, recession, and higher inflation, and I wouldn't take it off the table. And I know everybody thinks that inflation is coming down. I caution that a little bit. If you look forward, a lot of inflationary forces out there, huge deficits, greener economy, and then we got the restructuring of trade, things like IRA, the chips, infrastructure needs, they're all inflationary in nature." And Ally CFO also flagging concerns around consumer stress levels because of higher levels of unemployment. So intensifying credit challenges is what the CFO mentioned. So Ally Financial's credit challenges have intensified over the quarter as borrowers struggle with high inflation, cost of living. The consumer lender's chief financial officer, Russell Hutchinson, said on Tuesday, delinquencies in the company's retail auto business rose about a cumulative of 20 basis points in July and August compared to his expectations. And Hutchinson told investors at a financial conference in New York, "Our borrowers are struggling with high inflation and cost of living, and now more recently, a weakening employment picture as well." So a lot of these banks who have direct access to the consumers' financials are pretty much telling us that the consumers are struggling. There are borrowers that are struggling right now as credit conditions continue to intensify. And also the chief financial officer, Rush Hutchinson, highlighted the intensifying credit deterioration among its borrowers and said that the auto lender may experience some underperformance. I mean, that is just pretty much coming out there directly, as direct as it can be, telling us that, look, the economy does not look very supportive of an environment where the banking sector can perform well as interest rates come down. Inflation continues to be a little bit more elevated. Savings rates dropping down to under 3%. Credit card debt is at an all-time high. So there's a lot of things. There's a lot of signs of vulnerability throughout the year. And August U.S. jobs data underscored those stresses. And the pain is most linked to firms' retail auto loan book. And of course, we were down a little bit over 19%. Now, delinquency rates are also rising on credit card. And every time it has gone up, as you'll notice, we have seen recessionary forces come back into play. So this right here is the sharp increase that we're seeing in the overall delinquency rates. And this is, of course, the picture related to the record high credit card debt of well over 1.3 trillion and the record low savings rate at under 3%. So those two forces kind of coming together as consumers in general are financing their lifestyle on the back of credit card and not really through income or savings, because that is completely depleted down to the record low levels here that we're witnessing. So eventually, this is a little bit of a ticking time bomb, in my opinion, because what's going to happen at the end of the day is really if people start losing their jobs, if unemployment really accelerates higher, well, guess what? This entire thing is going to come crashing down because people are not going to be able to pay their loans, mortgages, auto loans, even credit card loans back to the issuers, which is the banks. And of course, the banks are going to end up taking the brunt of that pain. They're going to write them off as bad debts. So consumers going to be in a pretty bad situation, and the banks also are going to start to underperform given that there's a lot of debt out there outstanding among consumers. Student and car loans also have been increasing very, very sharply. As you can see that they've been on a consistent increase since 2006. And this right here is going to be the car loans. A sharp increase here after the pandemic, and of course a steady increase overall in the amount of debt here. And so 1 month ago, when multiple discount retailers were lamenting the sudden collapse in the U.S. consumer purchasing power, we observed the reason this unexpected hit to the U.S. consumption as the U.S. personal savings rate had collapsed, the growth in consumer credit was slowing, and in July, credit card debt growth posted its first decline since the COVID crash, just in time for another month of record high credit card rates. But fast forwarding just 1 month later, when in a stunning reversal, July consumer credit growth unexpectedly reversed the dramatic June slowdown and soared more than $25 billion to a new record high of over $5 trillion. This is total consumer credit monthly change over $25 billion. And this is revolving credit monthly change and non-revolving credit monthly change, all in all sitting at just over $25 billion, which again is a pretty significant increase. And this chart also scares people the most. People are living off of their credit cards. Look at what happened after each of those peaks. This one is going to be bad. Inflation has totally penetrated the middle class, which of course nobody seems to be talking about. And the banks are a very, very clear indication of how the middle class is doing, how the actual middle class in the US is doing. And if they're actually signing off on so many warning signs suggesting that, look, the consumer is not doing super well, living off of credit card, lowest levels in terms of savings rate, very high levels of credit card debt, and the bank's also suggesting for lower net interest margin, could be possibly because of a lot of write-offs for the bad debts if delinquencies start to really increase. But the bottom line is, I think recession fears are very underestimated, in my opinion, over in the US. So let me know your thoughts down in the comment section below. But I do think the XLF ETF overall in general is on its way potentially lower because it has been outperforming really well. I mean, it's one of the sectors that has done really well year to date. It is up over 17.6%. In fact, it's performed better than technology, discretionary, and communication services. The only other sector that comes to mind that it's higher than financials is utilities. So markets have in general become very, very defensive for the most part in 2024. But I think the lower it gets down to, I think the better the opportunity will be to buy some of the bigger banks like JP Morgan, Goldman Sachs, Citigroup, Bank of America. But the level that I'll be watching very closely is going to be right here at $40 per share. XLF is going to be the ETF that I will consider, or maybe even FAS. For somebody who wants to take on a little bit more risk, FAS is going to be closer to $91 per share is a level that I'll be watching for this particular ETF as well. So bottom line is, I think some of the bigger banks are worth buying on this weakness, but we're just going to have to wait and be a little bit more patient for better deals in financials and in banking, and more specifically XLF and FAS. Some of the levels that I'm watching, and I've already told you, $91 for FAS, and of course for XLF, we're going to be watching closer to $40 a share. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like, subscribe to the channel. Link's going to be down below if you want to join our Discord and our Patreon. As always, happy investing. I'll see you all in the next video.